Want to pay less tax on your crypto? Well, you can by harvesting your losses, and Koinly can help you. Hi, my name is Nelly, and today we'll be talking about how to save money on your crypto taxes using a strategy called tax loss harvesting. Crypto tax loss harvesting is a strategy that helps you reduce your net capital gains. When tax loss harvesting, an investor sells crypto at a loss to create a capital loss which they can offset against their capital gains and reduce their overall tax bill. For example, let's say you bought one BTC for $20,000 and one Ethereum for $1,000. The price of the Ethereum rises to $3,000 while the price of the BTC falls to $18,000. You want those ETC gains, so you sell at $3,000. Without tax loss harvesting, you're liable to pay capital gains tax on your $2,000 gain. But with tax loss harvesting, you can sell your one BTC at a loss, giving you a $2,000 capital loss, which you can offset against your gain, meaning you'll have no tax liability. In some cases, investors may also buy back the asset they've sold at a reduced price, but there's specific rules about when this is allowed. A wash sale is when an investor sells an asset at a loss and later repurchases the same kind of asset or a substantially similar asset. Effectively, it's when an investor creates an artificial or paper loss for the tax benefit. Most countries have wash sale rules, including the US, although they might call it something a little different. For example, in Canada, it's known as a superficial loss rule. Or in the UK, it's known as the bed and breakfast rule. Regardless of the name, most of these rules work in the same way. They prevent investors from claiming capital losses when an investor sells and then repurchases the same asset within a given time period. For example, the IRS wash sale rule occurs when an individual investor sells or trades an asset at a loss and buys back a substantially identical asset within 30 days. Now, while the IRS wash sale rule doesn't apply to crypto yet, it looks like this tax loophole will be closed imminently. And even if you think you can get away with it, you'll also need to pass the economic substance test, a common law doctrine that denies tax deductions when the related transaction lacks an underlying economic purpose. In other words, you should be very careful when tax loss harvesting to not create artificial losses. Koinly doesn't just calculate your crypto taxes, it can also help you optimize your taxes with our tax optimization tool. Once you've imported all your transaction data into Koinly, you can preview your gains and losses for the current financial year in the Tax Reports tab. If your gains are too high for your liking, head over to your dashboard and select Tax Optimization. You'll then be able to view your individual holdings and your unrealized losses and simulate selling these assets to realize a loss and see how it impacts your tax bill. If you have any questions, let us know in the comments below. I'm going to leave our resources linked in the description below as usual, including our help center, feedback forum, and how to contact our customer support team if you need help with your Koinly account. If you enjoyed this video, consider dropping a like, subscribing for more crypto content, and I'll see you next time.